The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I am Perry Sykes, and welcome to the Investor Resources Podcast. We would appreciate it if you would all subscribe to this podcast. Make sure you keep getting the latest and the greatest from us. And we would really appreciate it if you would take a moment and share this with your friends and family and coworkers, people that you think may benefit from hearing this also. Help us spread this word out. Thank you.
So today we're talking about a market that just has no top to it anymore. In fact, that's one of the interesting challenges for money managers, including us, and that is when you have new all-time highs, that means we've never been here before. What do you do now? Now, the only thing that isn't at a new all-time high is the NASDAQ 100, but it's regained some of its mojo and is getting pretty close. But the Dow Jones has just a continuous record of them this year. The S&P 500 has, and the S&P was not the S&P, the NASDAQ was, and then we got a little bit of a setback a couple months ago,
Sure.
And it's still trying to recover from there. But when you're looking at an all-time high, you say, well, where do we go now? How high is high? And as technicians, when we look at a chart, we're used to seeing something above here that gives us a guidance on what we should expect for tomorrow or over the next some given time frame.
Sure.
And once you're at all-time highs, sky's the limit. And that's caused a lot of press, both pro and con of late.
You get with all-time highs, you're going to get a lot of responses, and those tend to break down into two camps. It's we've come too far too fast. This is too high. This can't go on, and get ready for a pullback. This you should don't buy into this. Just wait for that pullback because this is too high. And then the other side is no, we're seeing money still flowing into this market. We don't think we're as high as we're going to go higher. And that tends to be more often the case. All-time highs tend to cluster together, and more all-time highs usually mean more all-time highs because the money's coming in. And right now, the market's looking, has a positive outlook on the election results, what that means for Wall Street, and cash flows are still coming in. Funds are flowing into the market, not out right now, and look for more new market highs even before the end of the year.
Let's go back a year before it became evident that Donald Trump was going to be President-elect Donald Trump. If we go back a year into 23, we had the ongoing concerns over what the administration was going to do in regulations, and Harris wanted to increase taxes on the wealthy because they don't pay their fair share. They actually pay the top 1% pay, top 10% pay 40% of the total tax revenue. It's a very small population. It's less than 600,000 people, less than 700,000 people pay 40% of the total federal tax revenue. And apparently, that's not politically acceptable. So given those concerns, we had the old adage that the market climbs a wall of worry. Well, it looks like the wall of worry has toppled over and is no longer a concern. You no longer have to climb over it. You can walk right over it because it's not an impediment anymore. And Perry, you just mentioned the flow of funds, because basically is a reference to how much money's coming into the market. And since the election, the amount of new capital coming into the market has continued to set some new records on how much in a given week. Now, so part of the question is, where's that money come from? And a good portion of that money that's coming in is not coming from U.S. investors. Retail investors are still salving their wounds or literally crying in their beer from the losses they took in 22 and the fear that they went through with the COVID crash, and some of them with the great financial crash of the mortgage debacle back in the first decade of this millennia. Those wounds are deep, and they still are causing people to doubt that this market can go higher. So where's the money coming
Right.
from? The money's coming from overseas. Overseas investors are looking at the U.S. and how strong our economy is relative to theirs.
Right.
Now, I'm not saying we have a rip roaring economy, but we have one that is still managing to progress and go forward, unlike many international situations. China comes to mind, Europe comes to
Yep.
mind, Germany and Europe. Um, you look Israel, their market has been disrupted with the war activity. So you want to find a place not to invest, look overseas. Look at your diversified portfolio. You probably find that
Correct.
there's a bunch of exposure to things that don't make any sense in the current economic environment. So other nationalities who can are funneling money into the United States, both in our treasury market and in our stock market. That's money flow, and market lives on money. If there's no money coming in, stock prices fall. In fact, that's part of our mantra: own leadership, sell laggards. If you own stuff that's not working in the current market cycle, why do you own it? Because it's an anchor to your portfolio, not an anchor that is stabilizing you like a foundation. It's an anchor that's holding you back, as in a boat trying to leave the dock that hasn't thrown off its lines.
And that's the biggest problem. People get weighed down with emotions about where the market is, how far it's come, new record highs, can this continue? And they talk themselves out of investing in a market that, like you said, Don, now has global flows, global cash flows coming here. Because while our economy is far from flawless, it's the strongest economy on earth right now. And when you look at where people are investing, they are deciding, hey, the US market right now, that's the place to be. And that's where the cash is flowing. So instead of ignoring that, why not say, hey, that's what is going on right now. We're going to follow that money as long as that continues. That doesn't mean you stop looking. That doesn't mean that's it. We're done. We're all in on the US market. Forget anything else. That's never the case. This is always these market allocations are always make good allocations. They're good until canceled, and they'll get canceled as soon as that sentiment changes. It doesn't even have to be anything real. It's just a matter of people stopped believing it could happen, and that can be a self-fulfilling prophecy. Once that cash flow dries up, the market cannot move to new highs without the cash coming in. And at some point that'll happen. It's not happening right now. So it's not a matter of all green lights and forget about risk at this point. You always have to watch risk. Risk is always there. It never goes away, no matter how good things look. There's always a risk in the market. Otherwise, you wouldn't get paid for being in it. That's why you're getting paid a premium to buy equities. There's risk there, but right now, it pays you to accept the risk, buy into the market, and let that run for a bit because it's heading higher and more cash is on the way. So right now, things are pretty strong in U.S. equity markets.
So let's go back into some specifics to just ask the question: why does the stock price go up or down?
Sure.
Because collectively, the stock market is just a broad collection of all sorts of alternatives that you can invest in.
Yep.
Stock prices go up because people want to buy them. It's that simple.
That's
When
it.
they start piling money into a stocks market purchase, the price rises because it's a supply demand situation. There's a limited supply. There is always a limited supply. A company may make a decision to add more shares to the marketplace, that's not usually a positive sign. When they're issuing shares, it's because they need money. So those shares are companies that are often um, in trouble one way or another. Take Boeing example. They've had to
Sure.
issue shares recently because they decided it was less expensive to do that than to try to borrow money given their current circumstances. So they diluted the share price by issuing more shares. But generally, what has been happening over the last several years is that companies have been buying back shares. And what does that do? Well, that reduces the number of shares that are outstanding. So if you had 10 million investors and the company decided to buy back 10% of the outstanding shares, share prices on the ones that are still owned are worth more money because there's fewer of them available.
There
That
you go.
forces prices up. Buyers come in, they've got money, say, I'll take that. That company's doing well. It's got a buyback program. Their shares are going to go up. I'm going to add more money to the pool, which bids up the price. So when you look at that from a macro standpoint with the market, that's happening around the world. Investors are recognizing the U.S. is in pretty good shape on a corporate level. We're
Sure.
not talking about federal debt. We're talking about how well is America Corporation doing? And generally, we're doing very well, particularly in light of the rest of the world. And you want to look to an area that's really risky. This is where a lot of new investors who've never been in the market before get in trouble. They don't have a lot of money, and so they buy cheap stocks because they figure cheap is a bargain. The number of stocks, and we just ran this scan last week, the number of stocks on the New York Exchange that are priced below $5 is almost 2,000 shares. That is abnormally high, and those
Right.
are companies that are they're borderline going out of business.
On the edge. Yeah.
They're on the edge, and if they can't do something to get their share price above $10, it's very likely that this next year they'll be delisted. They'll end up on the pink sheet, and and the pink sheet, only speculators want to buy them, and they don't buy much. It doesn't solve your financial problems if that's your situation as a company. So if you get excited and want to be in the market and you don't have a lot of money, we'd recommend that you start out with an exchange traded fund or a mutual fund, something that has some broader diversification to it. A good starting point, if you don't know what you're doing, would be the S&P 500 exchange traded fund. The ticker is SPY, SPY. I mean, you're going to end up owning the 500 stocks that are in the S&P, and you don't have to worry about the quality of them because eventually, if the company's on the verge of bankruptcy, the S&P crew will decide to take it out of the index. It'll get rid of it for you. Uh, the other side of the coin is they don't put companies back in or in the index until they're really expensive. So it's kind of a reverse decision making model. But the fact is, if you're a beginner, you don't have a lot of capital, you want some place to start your kids or grandkids account, that's a good place to start
It
regular
is good.
periodic accumulation until
It,
you've got enough capital to be spending some money on research or being able to get some advice on how to go from there.
and just never forget markets like we said, the US market right now is doing well. US corporations are doing well. All of these things are cyclical. They're always cyclical, and there are times when it's good and times when it's bad, times when it's better and times when it's worse. And so you need to be paying attention. That's what we do. We're always watching, taking the temperature of the market and the sentiment out there and where's the money going, and following that, because those cycles are never permanent. They're always changing. The tide's always coming in or going out somewhere. And you have to be constantly vigilant or you'll get left behind. And it's not like you need, don't ever let anybody hand you that pie chart and say, well, now you're fine. You're diversified. You don't have to worry about what the market's doing. You always should be worrying about what the market's doing, where it's going, and should you be in it or not, and where in the market should you be. There's lots of places to be invested, and that doesn't mean they're all good all the time. That's almost never the case.
don't rely heavily on forecasts.
No.
The so
Yes.
given that we're at all-time highs, there are forecasts that the S&P is going to be at 10,000 by the end of the decade. Maybe it will, maybe it won't. Back in the 90s, there was a forecast for the Dow to be 40,000, and then we got into the internet birth with Y2K and the bubble that we had with technology stocks there, and the Dow didn't make 40,000 in that period of time, and so that book became deeply discounted.
There you go.
But here we are with the Dow at 40,000. It was just 20 years early. So I don't
Right.
know that the Dow or the S&P at 10,000 is 20 years early, but it's not the reason you invest. You invest because actually business is doing very well. Uh, all businesses have struggled. The economy has cycles. Some industries do well during certain periods of economic growth, and others do poorly, and they rotate. That's why you pay attention to leadership and laggards. Focus on your leadership and focus on strength. That's it for today. Subscribe to our podcast. You have friends and family who have common interests. Share the link with them. Ask them to subscribe too. We appreciate that, and you'll be updated when we do our next comments. Thanks, and have a great day.